All right, everybody, welcome back to another episode of Wealth Wisdom. How you guys doing today? Eric,
Good,
Bill,
man.
beautiful day
Doing
today.
phenomenal.
All right.
Well,
Phenomenal.
it's chilly out today.
Cool. Yeah, I hit 32 last night.
It's
So,
freezing. Yeah. Up here in the Northeast, it's very cold. I'm not ready
Yeah.
for it. That's why I'm wearing my flannel today.
Light frost.
Yep.
I grow a bunch of fig trees, and I didn't realize that, but there was going to be a frost hitting. It can
Really?
be detrimental.
Did
Yeah,
you bring him in?
What do you do to protect the fig trees?
I bring them in before it freezes, but a light one is not that bad. If it just hits 32 for a couple hours, that's not a big deal. But if it was like dipped into the 20s, it could potentially kill them. So,
Wow. Is
If
this
they're not
are
protected.
these small trees? Like you can bring them in and out? Or
they are potted. Yeah,
Okay, yeah.
they're potted. So they're big pots. I have them in, but
can we get a photo?
But,
We could maybe throw this up an episode for everyone to see.
yeah.
Send us a photo.
Absolutely. It's
So
just
we'll
a little
put that
hobby.
in.
I have 14
Yeah.
of them.
Wow.
Got a pretty good yield this fall.
I always
Are
knew
you
you
a
had a
big
green
big
thumb,
guy?
but I didn't know to this extent, Bill.
Yeah. Picking 5 to 10 a day for the last month. It's been great.
Wow.
Wow, that's awesome.
Do you
Does
make
the
like
whole
a dessert?
family enjoy
Jam?
the figs?
Everybody loves them. Yeah, fresh
Yeah.
figs.
That's cool. I feel like that's like one thing that kids might be a hit or miss on the fig.
Very like sweet fruit. Yeah, very. I think they're really tasty. Like a friend of mine did it, and then I just picked it up, and I'm looking to actually expand my. It gets addictive once you like get going and do some.
cool.
What do you call it?
Plants are never addictive for me. So I think that's awesome for you.
Yeah. No, I hear you. It's like a little morning routine that I do. Water them, treat them.
I remember when you were injured and you hurt yourself this past year, I think all the plants almost died in the office.
I think they
That is
did
true.
that.
They were on the door when I came back. So I was like, did anyone do anything? And everyone was like, what? What are you talking about? Oh, there's plants here?
Yeah, I don't have a green thumb. It's very bad.
Water in them once a week is really all we needed to do.
It's true.
Welcome, everybody, to another week of Wealth Wisdom, where we're helping you build wealth and legacy.
Companies are like an organism trying to survive.
It's always a risk when you're investing in a company that's purely tied to someone's brand.
45% of Americans have gone into debt for a Disney trip.
All right, so this week we are diving into why really the main topic of this week is active investment, active management in your investment portfolio. We're going to dive deep into our philosophy, how we make it happen for our clients. Should you do it if you're working with an advisor? Should you not? Should you do it on your own? These are all questions we're going to answer in today's show. Very excited to talk about it. We also have we're going to dive into one of our stock holdings. This week, we're going to go over Eli Lilly as one of them, why we like it, why we don't, why our concerns were before we bought it. We're just going to lift the veil and bring you behind the scenes on that decision. And really, let's get into everything. Before that, we're going to go over some latest news this week.
A little market recap.
And a little market recap. It's been a while. We've had some great guests on the show. If you've been a loyal listener, you've only heard Bruce and a few other guests. So I think we've had the
Casey and Matt, the realtors.
Fava and Vieira team on. That was very good. So we're back to the standard show today. Let's dive in. Guys, first story, AI, of course. We can't stop talking about AI. But AMD is up 43% on this massive OpenAI partnership.
Before we were even talking about that, there was supposedly like some CEO somewhere, and they thought it was like AL or something like that. So they're like talking about AL during the earnings call.
Oh my God.
I just feel like it's funny because it's like the like .com, that era when everyone was like, well, what we did was we added .com right to our name, and so we see a lot of value there. And I just feel like everyone's like, we've added AI to our company, and let me tell you, there's a lot of potential.
Yeah, so this is a big partnership just announced this past week, October 6th. OpenAI is to deploy about 6 gigawatts of AMD Instinct GPUs. So it's just a big order from OpenAI. OpenAI, if you don't know, they're behind ChatGPT, one of the most widely known used AI software today. What do you guys think about this? This also brings up the story of, are we in an AI bubble? That also hit news this week. You had Jeff Bezos at a big conference in Italy this past week saying, hey, I think we are in an AI bubble. But it's not going to be like the .com. It's actually much better. So what do you guys think?
Eric, what are your thoughts? I want to hear right from the source.
I'm sick of talking about AI. No, I don't think we're in a bubble, but I think it's like anything else. Any new technology, there's going to be a lot of losers. So maybe that's what they're saying.
About. Yeah.
Yeah, it's anything else. But the stuff where we are invested in, I don't see it at all. There is some concern if, hey, one of the guys that's funding this whole thing, right? It's the big tech that's paying for all the investment. If he's concerned, then hey, maybe we should all be listening. But no, I'm not seeing bubble yet.
Yeah.
But I am sick of talking about AI. I feel like every time we talk about we're showing our advisors how the accounts have done. It's always the tech AI related stocks that are carrying the portfolio. But anyways, it's been the same story for over a year now.
Yeah, the outperformers. Had a lot of stuff that still is doing well that is not necessarily related to AI. But but he was saying though, it's a bubble in the sense that there's like these 13 people companies that have valuations like $15 billion. And he's like, that's just not possible. Right. Yeah. They couldn't be providing that much
value.
Yeah. Right. So that things like that, just like you said, there's going to be a lot of losers. There's going to be a lot of money flowing into some of these companies that are just never going to have that valuation. Never going to.
Yeah.
Never get there.
There's a lot of stupid money. Yeah.
And he's saying, that's why I think he's saying it is a good thing. If it pops, all of that will be washed away and you'll have the real companies remaining, which is this company. You've got the big players. And then you also have all the data centers, the infrastructure. That's real. Like there's real stuff here.
Oh yeah. And we as a firm, we're not looking at those like very speculative companies, right? Yeah. Most of our companies have earnings. They have, you know what I mean? They're growing their earnings. So it's not like they're not making money. So every time they have an earnings call every quarter, which may soon to be once semi-yearly, we'll see how that goes on. But they come out, they're making more money or they're giving guidance that they're going to be making more money. The earnings are revised upwards as opposed to downwards. And so those are the companies that we're looking at. So the AI investment that they're making is already shown to have an ROI for them.
Yeah. Yeah. And we're going to get into all that in the later half of the show, like how we do look at the fundamentals of our business and our strategy.
Yeah. And so where it is a little funny is when all these companies are commingling funds, so to speak, and are they just pushing?
Let's get into that, Bill. What do you think of this circular moment of Nvidia buying chips with that power OpenAI, or supplying the chips rather? OpenAI buys computing power from Oracle and CoreWeave. You've got Oracle financing purchase power. They're just passing trillions of dollars to each other. What are your thoughts on this?
Yeah, but I think the demand, so for these companies, they almost can't keep up with the demand with what they're trying to provide. That's why OpenAI gets a ton of stuff from Nvidia, right? But they're also getting chips from AMD. I mean, listen, anytime the economy in general, if there's any type of product or service that has a very high margin to it, okay, so it's making a lot of dollars, right, per dollar that they're investing in, there's going to be competitors that come into that space to make it a little bit cheaper, right, and take some of that margin. So you're seeing that. And that's what I think is happening in a lot of places. And then you have companies like CoreWeave pop up, and then Oracle's probably the one company that is less integrated, I guess, with everything. So some of these other companies CoreWeave is basically owned in a sense by Nvidia, or really they were a main investor just to get them up and running. But there's a need for it.
Yeah, Eric, what do you think about the round tripping of dollars here?
Yeah, it's
any thoughts there?
Yeah, the beginning of the chain starts with Microsoft, Facebook, Amazon, and if investors start to get concerned about their spend, right, they need to make sure, these three companies need to make sure they're getting revenue. They need to make sure they're getting revenue from AWS, from ad revenue, which then funds this massive investment in GPUs and AI. Facebook, ad revenue. Microsoft, their business revenue, and they're also their server farm revenue. But if investors get concerned with those companies and are calling for them to spend less, then everyone else in that chain gets affected. The money is no longer flowing down the line. Everyone else's earnings go down. All their stock prices go down. As long as those big tech companies maintain their monopolies, growing revenue or making money, everything else is fine. So it's a weird, it's a weird situation. Yeah.
Yeah. Yeah. Okay. All right. Cool. Other big news: Buffett made his big acquisition, OxyChem, for $9.7 billion, just on October 2nd. So this is the largest deal since 2022. Previously, they had purchased Allegheny for $11.6 billion. What OxyChem does, they manufacture commodity chemicals, water treatment, pharmaceuticals, healthcare, construction. What do you think Buffett and his team are thinking right now? Do you think it's a water play? Is it just a big pharma play? Is this like the rails that pharma needs in the future? Quick, any thoughts here?
This is a conglomerate, right? All the stuff that they do. And I know Berkshire has been a huge buyer of Occidental Petroleum, right? So that was the parent company of OxyChem for the longest time. I'm not sure what the relationship is with that. We've obviously been a long time owners of Berkshire as a stock. I just think it's just another case of they have a lot of cash.
This is an all-cash deal.
Of course, because it's Berkshire.
Yeah, of course.
And they have, I forget, how many hundreds of billions of dollars, right, on the balance sheet at the moment.
$47 billion in cash right now.
Yeah, they can come in again. This is a classic Berkshire play. They're buying a company that, again, prints money. It's boring. There's always going to be a need for it. They have all indispensable, right? It's another indispensable monopoly that Berkshire felt was bought at a reasonable price, right? And they were able to come in with cash, do it. I'm not sure why Occidental Petroleum wanted to get this off their books, but
no, it's definitely
Berkshire's always willing to buy something at a fair price, right? A great company at a fair price.
You got to trust in Uncle Warren.
He's got the cash. So the article mentioned heavy debt load. So, hey, go to a company that's got the cash to get rid of that.
Yep. Yeah, that'll make it healthier. All right, we're entering week 2 of a government shutdown. Bill, any concerns here? You think this is going to end soon? There are rumors that Trump could make a deal here, or the deal master.
Trump's making a deal? Oh, boy.
Yeah, week 2. And this plays into our other story where IRS has just furloughed almost half its workforce because of this.
Yeah, just spoke with someone last night, actually, who works for the IRS, who is being furloughed. So they were told last minute. They don't even know if they're getting paid. They don't know. Very little information has been given to the employees. Do I think it's going to end soon? I don't have a clue. Yeah. I don't know how. I really don't. I'd be completely guessing.
It doesn't seem like Wall Street
rainbows
cares.
And sparkles. Yeah, I think it will get figured out.
Yeah.
I don't know. What in the past with the shutdowns, how long have they've been up to 30, 35 days has been the longest. Am I correct in saying that? And then
I think so. Eric's on the data. He's drilling that. I hear him typing already.
No, the most significant was the 35-day. Yeah, the 35-day in 2018 during Trump's first presidency. And it was about the border, the Mexican border.
But is this a nothing burger? Do we care?
It's not really about what they're saying, oh, this is the sticking issue. It's something else that you got to look under the sheets a little bit to find out what's really going on. But
so do you guys care about that? Are you guys watching the shutdown? Does it matter? It doesn't seem like Wall Street cares that much. S&P is still doing fine.
I hate to say that. I feel like I'm numb to it at this point. Everything that's happened over the last 10 years with all these shutdowns. Yeah. Hopefully they get it cleared up soon. I think they will. Like I said, I think it will happen within 30 days. And then I think at that point, get things back to running. I do know from talking to an IRS agent, she just said that it was an absolute mess the last time this happened, season and things like that. And anyone knows that work as an individual, right, doing stuff with the IRS can be very tedious and things along those lines. That to continue into 2026.
Okay. All right, let's jump into that. Before, just a quick mention, this happened yesterday, so we're going to say it. Final draft of the Israel-Hamas conflict. They've seemed to have reached a ceasefire, which is great. And then oil So the financial, it's great for humanitarian reasons, but also for financial reasons. Oil prices have dropped, which seems to be good. Hopefully,
Yeah.
consumers
Anytime
feel
there's
that at the
unrest in the Middle East, right? There always seems to be
pump.
oil
A little
spikes.
spike. Yeah. Yeah. And so I guess maybe during the furlough or right before the furlough, the IRS was able to get 2026 tax bracket information out. So they just unveiled higher federal tax brackets for 2026 to adjust for inflation. It's a little bump. Bill, you've got, I think it's up to, the standard deduction is up to $32,200 for a married couple, which is only up like $1,000, I think, from last year, if I'm correct. And it's
Yeah, what was it, like
16,000.
15,750 or something like that, I believe,
Yeah.
on a single. So double it was the.
Yeah, so it's a little bump, which is
Minimum
nice. This year for single taxpayers, it's 16,100. It's good. I think the top rate for 2026, the top rate of 37%, it applies to individuals with taxable income above. So they also changed the how much you're making. So if you're making above 640,000 a year,
They didn't change how much you're making. They changed the tax brackets. But
the tax bracket. Okay, so it's
it'd be nice if they
37%.
changed how much we were making, right?
Can they do that? Quick wave of the wand. So yeah, so 640,000 for married couples filing jointly, earning $768,000 or more for 2026. It's top bracket.
That's the top rate. But they did move up all brackets, though, right?
Yeah,
Like that's just the top one.
and we can link that in the show. You can see a graph. We'll pop that in there. But let's jump into that's the news. Let's jump into the main show.
That's the news.
All right, we've got active management. I was just listening to a big podcast the other day. I don't know if you guys listen to our good friends over at Diary of a CEO.
I do not. No.
And we don't know.
Something I should pick up.
It's pretty good.
Wait, who's on that podcast?
It's basically one guy.
A huge fan.
I just know. I'm not even a.
He's like,
it
my
just
best
crossed my
buddy.
radar. It just crossed my radar.
It's like, who is it? You're like, I have no idea.
Dude, you're not supposed to put me on the spot like that in the show. No, Diary of a CEO. It is a huge show. Steve Bartlett, he's a big entrepreneur. He's got a net worth of, I don't know, whatever. They have 12 million subscribers. He's built a big platform for podcasting. It's pretty cool.
Yeah, slightly more successful than us, I would say.
Well, we're inching closer and closer every day, I think. And if you're still listening to this, give it a share so we can catch up with Steven here at 12.1 million.
Yeah.
All right. But he recently had a show that I had listened to. I'll pull up right now. And they were talking about financial implications. Should you be investing? He's had Ray Dalio on the show. We've talked about him before. Where's the show? He had a panel, which was very cool. Different investors, different influencers. Number one money savings tip. Yeah, this is September 15th. It aired right before he interviewed Matthew McConaughey. Bunch of Raoul Paul was on it. Jaspreet Singh, Humphrey Yang. These are all big guys in they're call them influencers in the financial space. Basically, at some point in the show, they were talking about active investment and how the average person should never jump into active investment in the stock market, and that most people are going to do fine just putting their money, parking it in the S&P. There was a lot of debate there. Raoul Paul, he's a big Bitcoiner, hated that advice, but I want to hear from you guys today. I want to open this up.
Ron Paul, the senator?
No, Raoul Paul.
Oh, Raoul Paul. Okay.
Raoul.
Yeah.
RAOULPAL. I want to hear from you guys. You know, why? So at Fox Hill Wealth Management, we do boutique investment, active investment for most of our clients. First of all, what does that mean? Bill, I want to hear from you. Describe it to me like I'm a 5-year-old.
Like a 5-year-old, like a 4-year-old. What's that from that famous Denzel Washington? Is it Philadelphia? When he goes, explain it to me, I'm a 5-year-old. You know what I mean?
Give it to me simple.
Keep it simple, stupid. It's probably different, right? You hear that word, boutique wealth management, and no matter who's saying it, it's probably a little different, right? Because it's in their mind, it's how they believe in financial management should work, right? I think with us, we don't use any outside products for the most part, right? So we don't use ETFs or mutual funds or things like that. We
Or
provide
sub-advisors.
sub-advised. Yeah. We're not using what's called third-party management systems, or, you know what I mean?
Yeah.
Things like that, where we're doing our
Because
we
we're
run into-
fee only, right? So we're not like pushing products like that, mutual
yeah,
funds.
there's no
stuff like
we're
that.
not getting like incentives, commissions, we'll say,
Yeah.
over extra costs and things like that in order to put someone in a product that all of a sudden we make, I don't even know what the numbers are, right? 7% of the investment. Like annuities, for example, the person who sells that to you, they get somewhere between, call it like 1 to 8%, maybe 9%, right off the
Depending on
bat.
the
So
product.
if you gave them $1 million, they could earn 90 grand, they could earn 70 grand, they could earn 40 grand, you know what I mean, right off the bat.
Mm-hmm.
No matter what they do, right, going forward. We actually had a client recently who, I would say, really got screwed over, right, by a person, quote unquote, who was a financial advisor, and put even their kids in annuities, which made absolutely no sense. But
Wow.
so we have our own investment strategies, right? So we do it in our own way, right? So we have a strict criteria for why we buy a stock. We've got criteria for when we would sell that stock. And then once we do sell it, we're with the proceeds of that sale, right? And that's the very simple aspect of it.
Yeah.
And we utilize the top ranked research in the world in order to make those investment decisions, right? So we try to take emotion out of it, try to take media out of it. And I would be remiss to say that sentiment and things like that, we do take into consideration, because I do feel like that is something that you do have to think about when investing in a stock, but mainly we're going by the numbers, right?
Mm-hmm.
So we're going by the numbers, and that's what we're trying to do. And when we say, in our mind, we have a certain philosophy about how much money you should be keeping in cash. And in terms of your life, we go through a financial planning process in order to determine that number. And then we utilize our investment strategies where we invest for growth. We invest for growth in income in a separate strategy. And we will do fixed income in certain cases too, for more of like cash management services, right? For liquidity purposes, for people over maybe within 1 to 3 years, right? Of what they're looking to do with their life. But we are big believers in the market. We utilize these strategies in order to grow people's wealth. And what our goal is to exceed inflation. We want to beat benchmarks, right? So our goal is to beat the benchmarks in net of fees, right? So net of the fees that we charge, we want to beat benchmarks. And that's what we're trying to do.
Eric, why not just buy the S&P for our clients?
Don't get me wrong, the S&P is a great alternative if you don't have access to good active managers. I can't remember what the stat is, but there's plenty of active managers that take a fee and consistently underperform the market. So you want to you got to do your research.
Manage huge amounts of money too. You'd be amazed that they're able to do it.
And keep their jobs. Yeah. So it seems like it would be easier as a firm to say, hey, we're going to buy the S&P, we're going to buy this ETF, why do you guys, like, when I came in, you were like, this is our philosophy, this is why it's important. Can you share that right now for people listening? Like, why is it important for our clients that we go through this process?
Because what you'll find in this industry is a lot of advisors are doing the same thing, which is add a client, bring on the assets, throw them in ETFs and mutual funds, and never look at the account again. We wanted to provide that extra level of service, that extra kind of competitive advantage that comes from active management. We have a young history, but having an actively managed portfolio with some concentrated positions, we've been able to outperform a lot of the indices the last 3 years. But you have to follow a discipline. So the reason we do it is we want to be able to beat the market, give our clients an advantage, grow their assets so they have more when they retire. We've done that through using consistent research, that JP Morgan research that Bill talks about all the time, and staying disciplined with our strategy. But that's the reason to do active management. You need to have an advantage. So that's otherwise it wouldn't be worth it. Yeah.
Okay. Do you think if you're starting out, do you think investing in the market is enough to get ahead to allow you to get where you want to be financially?
Versus
Versus
what?
like in general,
Yeah.
what do you
No,
a
I
little
just
more
think inflation, you've got a lot of talk about inflation the past 4 years. What is the real inflation rate this year? They're saying it's 3%. If you look at the past 5 years, it was much higher than that, especially during COVID years. Then at the same time this year, you've got a devaluing dollar that's down 12%, which is also a hidden inflation right there. Do you think the S&P, I'm trying to ask, if you do that, is that enough? Or is that another reason why you guys believe in the active investment? To be able to get that alpha that's needed
Justin,
today.
the other thing to factor in too, right? Home prices are up 50% over the last 5 years. You need your money working for you if you want to be able to afford things. That's because those inflation numbers aren't the whole story, right? The house is the biggest cost. It's up 50% of the year. If you want to buy a new home, or if you didn't own a home prior, you're out of luck. You need to have your cash working for you so you can save for those big purchases.
Yeah, no, for sure. I completely agree. I think a lot of people I've talked to, they hear active management and they get scared. They feel like it's risky. Bill, I don't know if you've heard that as well when you're talking to potential clients.
I think some people, the mistake that I think a lot of people make is that they equate it with being like a trader, right? So it's, oh, this is happening in the market and we're making a quick move and that's what it, trying to think about this. We do trade, but I would not consider ourselves traders. You know, we're like we're investors. There are certain things that will dictate us making a trade, and there are market things, but it's more based upon, okay, we're looking at a company that's supposed to be making a certain earnings. They have the analysts who are looking at this company says, hey, based off everything that's going on in the world, whatever it might be, whether it's geopolitical, whether it's just what's against their competitors, whether that certain area of the market is really doing whatever that might be, right? They're looking at it and they say, hey, this company is going to make more money. And if you think about just what like a stock is in general, it's just a reflection of their earnings in the next like 12 to 18 months. Okay. And how many times the market is willing to pay for that stock, right? Or pay for those earnings, I should say. So that's really all a stock price is, right? So it's what the market thinks it's going to do in the next 12 to 18 months and how many times they're willing to pay for that, right? In a high growth area, you're going to be willing to pay a lot more, much higher multiple. If it's what deemed to be a lower growth business, you're not going to pay as much for that stuff, for those earnings.
Of course. Yeah. We were just talking about that before. Certain companies having a incredible PE ratio. I think that's what you're talking about right now.
Right. They're priced to their earnings. And it just, so you need to do, when you say, and let me ask you this, you said, do I think it's enough? Do we think it's enough? What are you alluding at when you say, do you think it's enough?
The question actually was I'm stealing that question from Diary of a CEO, and they asked that question. I thought it was pretty interesting. If you're just starting out and you're like 20 to 30-year-olds, you don't have a lot of money saved. Like, how do you get ahead? Like, how do you afford that home that you want to buy for your family? And I don't know if it's simply just...
Were they saying to be more aggressive than...
Yeah, that's what they're saying, right? Raoul Paul came on. He was like, listen, the S&P is not going to cut it for you. It's just not... You're not going to get there. Now, I would personally, I think any investment is better than none. But even the NASDAQ's going to push you up to 19%. He was saying at least be in the NASDAQ and not the S&P. We talk about the S&P a lot. So I just wanted to hear from you guys.
I wouldn't argue that. Where our growth stocks are probably more heavily weighted in NASDAQ companies right now. I wouldn't argue
But one of the problems, though, is that the overall risk. So when you see that's if when you're younger, you want to take risk, right? No question. You've got more time to recover if something happens. It's not as financially devastating, right? If there's a pullback, things along those lines, it's got to be a consideration, right? Yeah, you do want to make sure that you're calculated, right? Calculated risk, but you're at the same time, you're taking on risk because typically, right, you get rewarded for taking on risk, or ideally you do, right?
Yeah.
So,
Yeah. How do
so
you guys?
we're-
Yeah. Sorry, I'm gonna cut you off.
but just saying where it is, if they're saying that, hey, you want to have some alternative assets in there, things along those lines, I would agree with that. But you got to keep in mind too, some of the stuff that they're talking about, and I know it's done really well, whether it be like cryptocurrencies or things along those lines, they do. Not that they're going to go to zero. Not, I think at this point, I think that would be a stupid statement, but they have massive volatility to those too.
Yeah.
If you're looking to buy a home in the next 2 years, do I think probably putting the money in a cryptocurrency is the best idea? Probably not, just due to the volatility of that asset. Because, hey, in 5 years, you could be doing, really well, but you don't know where it's going to be in that short term, right? I mean,
Sure.
we've seen massive.
And that's something we've talked about that. We help our clients manage those short-term goals and what they're going to need in the short term so that they don't have to pull their money out during a pullback, which eventually will happen. How do you guys manage, how do you guys think of diversification? Because that's the other thing I've heard is if you're actively managing, are you diversified? Because the S&P is supposedly diversified. Eric, what would you?
You're talking about the index itself.
Yeah, I'm saying
Do
when
the-
I talk to people, they're like, if you guys are just picking stocks, you're probably not that diversified. So it sounds riskier to them. So what would you say
but I
to
think
that person?
Those people, they have to have an understanding of what like true diversification is.
Okay,
Right.
go on.
If they don't know, I forget what the breakdown is of the S&P 500 right now, but what is it? It's something
It's
like
44% of the S&P is owned by the Mag 7.
yeah.
Almost half.
Rather said differently,
Yeah.
the Mag 7 comprises 40% of the S&P.
Yeah. So 493 companies, right?
Yeah.
Take up that other 50
60%.
some odd percent. Yeah. So so if you thought about that's not really being diversified, right, in a sense. But
Yeah.
the only problem with that too is that I'm a believer in concentration. So in order to outperform the market, you do have to have some concentration. And so that is a thing. But if you look at the standard deviation of a portfolio or things along those lines, you're going to see that our portfolio is very diversified in that sense.
One line I've heard you say a lot, and I love it, is your portfolio will never go to zero, and if it does, we have huge issues on our hands. You better be running for the hills. In other words,
you better.
It's like nuclear war. Yeah.
I hope you have guns and ammo. That's the thing, right? Because that's the only thing that's going to save us at that point. It's not.
Yeah.
It will be a full out. I don't even know, Mad Max situation. It's just not. The public markets collapse point where these companies are zero. Think about now you can never use Google again. You can Amazon is all these things like our way of life would just collapse.
Yeah, Amazon comes to my house way too many times a day for it to be non-existent.
Yeah, so that's a thing, and so it's in that sense that's very that's like I always tell people, I don't make any guarantees on returns, I don't make any guarantees on really anything, but I will say that the one thing I guarantee is your account will never go to zero. Because I do hear people say that, what if I lose it all, Bill? What if I lose it all? And I'm like, that's not going to happen.
That's what I'm saying. People, for some reason, hear active investment, active management, and they hear risk. And I was shocked because I'm like, it's not risky. It is diversified. We have a diversified portfolio. It's well thought out. It's using the best research that we can get our hands on.
We have across at least 5 or 6 different sectors. You know what I mean?
You guys have a great investment committee, pushing each other. There's not just Bill, you're very good about saying you don't come in those meetings with, hey, it's my way or the highway. There's a lot of give and take.
Tries to.
Yeah. We push back.
We'll see.
No, but I think that is healthy. That's very healthy to have on the investment committee, to have that debate, to make sure you come to those meetings ready to prove your point. So I think there's a lot of good stuff there.
I would say in terms of you looked at actual risk, right, where we're equivalent with buying an index fund in a sense. Because even if we did have a big drop, so let's say we own a basket of 15 or 25 stocks or things like that. If one were to go down drastically, say you even had, I don't know, like a 40% drop in one of the stocks, right?
Mhm.
Something happens. I mean, on an average day, like your portfolio would, I don't even know, it would go down pretty minimally.
Yeah, it'll go down like 1% or 2%.
Yeah, it's really not a hit that you think it's going to be. So that's
another thing is
that example. They need to see that. So it's if maybe we should do a better job of saying, here's a theoretical portfolio. Here's what would happen if this stock got chopped in half, right? Because something happened. I don't even know.
I think that's another thing to highlight is like when you hear the word active, you mentioned this a little bit, but I want you to go deeper. Are you guys you're not day trading this stuff? Like we don't have traders at the desk like calling people, buy this now, buy it. It's not some of those movies.
Every stock we pick, I think at its core, we want to hold it for the long term.
Yeah.
Ideally, if we trade again, I'd be happy, but that's just not realistic.
In our growth stock portfolio, I believe probably over 10 of them we've held more than a year, actually. The newer ones, Robinhood, Tiva, Nvidia, I think I'm missing one. But yeah, those are just a few of the newer ones. The rest we've held more than a year, and they're all at long-term gains. So
BJ's is new.
If we go to sell those, they'll be taxed at the lower rate.
Yeah.
Which is something we will factor in for clients.
Yeah. No, I think it's a really interesting topic. I think if you are going it alone and you don't have a financial advisor and you're not willing to do the work, like you guys said either before we started recording or at the top of the show, what do you I think you should still probably like park it somewhere passive. Is that correct? Like for the average listener?
I don't think people realize sometimes the risk that they're putting in. We've had a great, obviously 22. And again, a lot of people I know who were doing, stocks during COVID and stuff like that, they gave up everything that they made, right? They were like, I'm killing it right now. I'm killing the market, Bill. Maybe some were like, we're not doing quite as good as what you did, or maybe they did a little bit better, you know what I mean, than what we were doing for them. They thought that they figured it out, something like that. A year like 22 comes and they go, wow, I lost even more than my principal. And they're kind of like, what? Bill, maybe I should just turn this money over to you because your accounts have done really well since that. You know what I mean? Because they just didn't recover. Because there are stocks that they'll have amazing runs and then they'll go down and they won't recover because you have these frothy markets. So that's why it's so important to be tying things back to earnings and that, because like I said, that always that's the underlying market always will go back to that. Are they growing their earnings? Is it a growth? You know what I mean? And how much are we paying for those earnings? It's always going to come back to that. So you always have to keep that in mind. And again, a company could be losing money, right? And so their earnings are losing, right? But then their loss is set to decrease significantly. They still might be losing money, but that stock price could go up significantly based on that, because eventually profitability, they're on the path to profitability. And then once that happens, it's kind of gangbusters in that stock, right? It starts to go up, but you actually see a lot of the bigger gains as the loss goes down. That's where you can get some really good growth. So that's the thing, is those are all the things that we're looking at. Whereas some of these companies, they have no revenue in sight. Yeah. And they're just, and right now is one of those times where that's happening.
It is.
You see a lot of stocks that, this stock's up 600%, 800%, all this other stuff. I just threw a little money into it. It's done so well. But the reality is that could come down and well below, you know what I mean?
Yeah.
Very quickly. So yeah, we're trying to balance that, right? We obviously want to grow the money, take advantage of some of those right aspects in the portfolio, but in a very calculated manner. We do focus on downside too. We want to make sure that our clients are not like financially devastated or anything like that if something were to happen.
Yeah, of course. Yeah. No, I think that's huge. But I just wanted to wrap up this part of the show because we got to move on. But I think just as a wrap up, correct me if I'm wrong, add anything if I miss, but it sounds like you guys you earn the fee. I'll just put it that way. Like you're actively managing and you're overperforming the markets, and that fee is definitely earned. So like clients don't mind that they're paying the small minimal fee you charge. Almost in some, I've heard people even compare you guys. They'll ask, oh, it's like a hedge fund. I'm like, no, it's not. It's just at all.
It just goes to show
hedge funds are taking
how much
money off your performance too.
Right.
That's the thing.
Yeah.
There's just so much information out there in the market, so many different products, so many different people always want to compare it to something. They want something that maybe they quote unquote understand. Even if I think like a lot of times they don't even understand what a hedge fund is, right? They just see it as
They watch the
not
movie
doing
Billions.
this, so it's gonna be this, right? And it's like, no, that's not. It's a investment strategy, and it's time tested. It's been around for over 50 years. It's worked well throughout the times. If the market goes down, we will go down with them. You know what I mean? In our, say, for example, our growth strategy will be affected
Yeah, and everything
as
else
well.
will be affected
It's not,
as
yeah,
well.
exactly. It's not, I'm not saying that like, oh, every year we're up money. That's not necessarily the case. In a down market, we will go down as well. But over time, it's a long-term investment strategy where we outperform term. And in my mind, the long term is like 3 to 5+ years. And then we use an income growth strategy to help steady that.
Okay.
So people who are maybe like in retirement need steadier income. So they're getting dividends. That dividend is expected to grow in the next 12 months to help them keep up and combat with the cost of inflation, allowing them to keep living the life that they've grown accustomed to and do the things that they like to do and not have to worry about inflation and things like that. I've had a lot of clients who say, hey, I'm so thankful, Bill, that you've talked to me about this. And even in the tough times, say in 22, we stayed invested. We kept the course. I have some friends who invested so conservatively and they're really hurting now.
Yeah.
Right? They're really hurting now. They don't have, when their roof goes or their this goes, to me, it's like, I can just grab out of my account, no problem. Doesn't affect me in the slightest. Whereas some of my friends are really hurting. And these are people who maybe had pensions with, you know what I mean, with a rollover, things like that. They've, like I said, they haven't had the growth. It hasn't kept up with inflation.
Yeah. No, it's
in the
so
same
true.
sense where
So
we've
true. We even
done
had that client, that prospect who told us that they had been in cash for the past 6 to 7 years and they were near retirement.
what kind of like looking for a time,
Yeah, they were like waiting for the
Yeah.
time in the market and they were just afraid to get in because it was always, and I was like, oh, do you remember that call? And we were listening and it was, oh my gosh, it's a long time.
It's
You've missed
time in
out
the
on
market. You're
gains.
never going to find, even there's 1,000 studies that show, hey, even if you invested at the worst time, right? Like you're talking about the cliff before
Big drop. Yep.
anything. It's, if you have a long-term outlook,
You're gonna do
you
well.
still need to do it. So it's just so important. There's no perfect time to get into the market. That you have to, it's more, when am I going to be spending this money? And if it's further down the line, then you got to be taking advantage of. I had a client who, I still remember, this was in like 2010. They're like, we're going to have another pullback really soon. It's going to happen. We just had that 47% pullback. This is going to happen. They had a ton of cash. They had actually bought some real estate during that time and sold it when the market had crashed. So they got some great deals, sold them. It's going to happen. They just kept telling me, the market looks frothy. It's gonna
happen.
They said it in 2012. They said it in 14. The whole time I'm like, guys, you're missing out on a lot of gains here.
Interest rates are so low. What are we doing here?
They were very, I don't even think they kept saying it over the course of 8 years, 10 years. And it's like, your money could have doubled in this time.
Yeah.
So again, there's no perfect time. No. And that's the other thing too. I don't care who the expert is. Nobody really knows, right? You've got these top economists out there who are making all these predictions. They're always wrong. I shouldn't say that. They're not always wrong, but there's a lot of, they're making predictions based off of data. There's so many variables though. If they don't have the right variables, which a lot of times they don't because the market it's constantly changing and there's constantly new things that are being brought into it that are catalysts. How can you make a forecast when you don't have all the data? You want to try to put in all those variables, but you're always going to be missing something.
Yeah.
That's the problem, especially in a system that is designed to, in every way, is designed to make as much profit as possible. All those companies
Yep.
are designed. They have a CEO whose job is linked to the stock price, right? So they're doing everything they can to
boost it. Yep.
boost earnings, to grow earnings over time. You've got a board who's overseeing that CEO who says, if you don't do this, you want to be one of the top 0.02% of people paid in this country. You want to make 30, 40, 50, 100 million, whatever it might be. If you don't do it, we're going to get rid of you. You know what I mean? So we're looking at you, you know what I mean? And
Sure. Yeah.
and they're not your buddy, right? Because they probably have a lot of stock in that company, things like that. They're all these things are in place for that little carrot, right? For them to do better. So that's the thing. And they're going to be willing to do anything. They're going to,
Yeah, sure. Their
whatever
interests are
needs to
aligned
be done,
make it
right?
happen.
Yeah, they're gonna make those changes. So when you have that and those incentives out there, people are they want to try to take advantage of it. And you want to be, as an investor, you want to take advantage of it, right? And take advantage of all the things that the capital markets come with. So I mean, when you ask too, are there other things people should be doing? Yes, probably. There's maybe some other things you can be doing. There's obviously like huge chances right now in cryptocurrencies and in alternative assets such as gold. Obviously, we've seen a huge run up this year. Some of that might be due, like you were mentioning too, the US dollar has been valued a little bit in terms of other
12%.
currencies, which probably could be because if they're looking at our debt, other countries who used to hold a lot of US treasuries, and they're saying, I don't necessarily want to hold US treasuries. I think we're going to go to take some of our balance sheet.
Yeah, it's a hedge. It's
right?
a flight to safety right now for them. Yeah.
And these things come in cycles, right? So we could back, and if we get a hold of our debt, maybe then it does become more of the reserve. Gold's been shifted to more of the world's reserve.
Yeah, for sure. Yeah.
Yeah,
so I think it's great. Let's move on. Just the last wrap up here. Let's dive into one of our portfolio holdings. We've got Eli Lilly this week. Eric, when did we buy it, or what made us buy it at that time? I know Eli Lilly, if you guys are listening, they are a biopharmaceutical company. They have a GLP-1. They've got tons of products. Their CEO was just interviewed recently, basically on the GLP-1s. And they've been working on it for the past 16 years, honestly. Why now? What were you guys thinking? Can you give us a little insight into everything for the people?
It's all about GLP-1s. Okay. Their big product, Mounjaro, it's over in their revenue, high growth. Revenue rose 60% just this past year. And they have a competitive advantage. We've seen it take market share from Novo Nordisk. We saw Viking Therapeutics, their oral pill, we saw that had more side effects than Eli Lilly's. So that stock was actually down after their trial phase. So they have a nice competitive advantage, and they're in a space that's going to continue to grow. And it's hurt the rest of the healthcare sector because guess what? When people aren't obese,
they don't have
a lot less issues, right? No one's buying insulin. There's less heart issues. There's so many downstream effects that get eliminated. Yeah.
Right. I think that's where the GLPs first came from, was a diabetes treatment. And then they discovered that it was also great for weight loss.
Yeah.
Which is why you're seeing this rise right now.
There's some old companies that we used to own. We no longer own them. It may have even been, one was like Edwards Life Sciences. It was valves for heart issues. But less obesity, that goes down. That stock went down.
Oh, wow.
What else is down? There's a company that we used to own that helps with sleep apnea.
Yeah,
people overweight.
Yeah, right.
That stock went down significantly. But we're revisiting the healthcare sector to see where growth opportunities might be. But we've seen so much investment leave the healthcare sector because everybody's worried about, which is a good thing, right? People are worried about people being healthier because of the downstream effect of these GLP-1s. Good thing for people, not good for all these healthcare companies.
Yeah.
But,
cool. Bill, what made you like Eli Lilly? Anything different from what Eric said?
The GLP-1s were obviously, they're a diversified pharmaceutical, but their GLP-1 in a lot of cases, right, outperformed most of the other ones that were on the market, right? So you saw more weight loss, right, and lines over Novo Nordisk. I think also the fact that they were coming out with an oral. I personally, this is just, and some of this is intangible, right, like research, but personally, I don't think I would want. I know people with diabetes, right? They're going to do it all the time. They're going to stick themselves with needles, things like that. I was just thinking more along the average person. I don't think wants to necessarily hit themselves with a needle all the time to take the GLP-1. They're in the process of, Eric was saying, coming up with an oral one. It actually, the stock did take a big dip when the results of that came out. They were hoping to see about 15% in weight loss on the average person. I think it was more like 13. You know what I mean? Is what we saw, which is not nearly as much as the injectables. But I think for someone who says, hey, I'm not really big into needles, I still want to lose that 10, 20, 30 pounds. I need help with it. I'm not able to silence that, that food craving that they have. That's what people say is the GLP-1s, is that you just don't get that feeling where you're like, I need to eat that bag of chips. I'm sitting.
You just don't want to eat.
I'm watching TV. No, that's what it is, though. It's more like you eat to live, not live to eat. That's what it is. It kind of silences that feeling. And obviously now they're finding out that it's with other addictive.
Oh,
so that food addiction, they're finding it's actually
alcohol.
with other things.
Alcohol.
Yeah, exactly. Other bad habits that you have. For whatever reason, I wish I knew the science or why it's affecting almost the brain chemistry.
It's about impulse control. Yeah.
Right. So they're finding that it helps in these other areas. Obviously, they're not marketing it.
And eat 10 bags of Doritos.
You know what I mean? They're not marketing it in that sense, but it'll be interesting to how that gets played into maybe some other areas. But having that oral option that still, like I said, performs pretty well. I think for the average person, that's a huge market to get into with all those things. And even, like I said, we bought it before that recent big pullback. So when that happened, but again, analysts still have raised earning estimates, right? There was no lowering of earning estimates. We stayed in it.
Yep. That long-term investment approach. There you go.
We've had a great recovery.
Yeah.
Back to where we bought it and made money for our clients. You know what I mean? Since then. So it just goes to show you that going back to the research, doing things like that, I would say our investment philosophy, right, is looking at the numbers, looking at the research, things like that, and then obviously using a little common sense, right? So this is going to do well.
Sprinkle it in there.
In our own lives, things like Peter Lynch, right? Great example, ran the Magellan Fund or some fund.
Famous, yeah.
I don't know if it was Magellan or if it was another one, but did a great job, but he thought about things very practically, right? And how he did it. So he was more like, okay, if we buy this.
Yeah, he was a Magellan Fund, you're right.
Yeah, and we think, though, that this certain stock is going to go up, and here's why, right? They do really well here. They're expanding in this area, right? So he had bought McDonald's. He felt that it was really going to expand in certain areas. And he's just think about if they keep their current margins on those stores, and yet they're all over the world, what is that going to do for that stock? And obviously,
it's interesting how
for a long, long time.
I wonder how Mickey D's is going to do with the rise of GLP-1s. All right, I think that's a great spot to leave it there. Everyone listening, thank you guys so much for listening in every week. Again, if you found value in this, give it a share with a friend who would also find value. Let us know in the comments what you want to hear about next, and we will see you next week, next Friday. Thanks, guys.
See you then.
All right. Do good, be good.